In 1901, J.P. Morgan paid $480 million for a steel company. Adjusted for inflation, that's $17 billion. And for context, that same year, the entire federal budget of the United States was $525 million. One company was worth 91% of what the government spent in a year. Andrew Carnegie walked away from that deal with $225 million in gold bonds. At the time, that made him richer than the U.S. Treasury's gold reserve. He didn't build that by accident. Neither did Rockefeller. They didn't just dominate industries, they rebuilt how those industries worked. They controlled inputs, they owned distribution, they set the terms. By the time competitors understood the structure, the game was already over, and the danger wasn't in the price. It was underneath it. If this walk through financial history sharpened how you understand concentration risk, take a moment to like the video. It quietly tells the system this work has value. But here's what almost no one asks. How did two men restructure the plumbing of American industry so completely that it took federal intervention to undo? Picture Pittsburgh in 1875, dozens of steel mills, hundreds of oil refineries, competitive markets, thin margins, constant innovation. By 1900, one man controlled 66% of American steel production. Another controlled 90% of oil refining. This wasn't a cartel. It wasn't price fixing in the traditional sense. It was structural dominance. Carnegie and Rockefeller didn't just win market share. They rewired the incentive structure so thoroughly that competition became economically irrational. At the time, this looked like efficiency. What no one questioned was the structure holding it up. Start with Carnegie in 1872. The steel industry was fragmented, prices were volatile, quality was inconsistent. He faced a real problem. Steel was becoming essential infrastructure, railroads, bridges, buildings, but production couldn't scale reliably. Carnegie's insight wasn't technological, it was structural. He implemented cost accounting when most manufacturers didn't even track unit costs. He knew the price of every ounce of iron ore, every ton of coke, every hour of labor. And he understood something critical. Steel was a volume game. Margins compressed when production slowed. But if you could run at maximum capacity continuously, you could drop prices and still profit. So he did. He cut prices, competitors matched. But they didn't have his cost structure. They bled cash. He bought them. Not hostile takeovers, just patient acquisitions during downturns. Rockefeller followed a parallel path in oil. In 1870, refining was chaotic. Anyone with capital could build a refinery. Prices swung wildly. Waste was enormous. Rockefeller saw inefficiency as opportunity. He negotiated secret railroad rebates, lower shipping costs in exchange for volume guarantees. That gave him a structural cost advantage. Then he used that advantage to offer competitors a choice. Sell to Standard Oil at a fair price or compete until bankruptcy, then sell for nothing. Most sold. By 1880, Standard Oil controlled 90% of refining capacity. It worked, but only under conditions that would not last. Carnegie's next move was vertical integration. He didn't just own steel mills, he bought iron ore mines in Minnesota. He bought coal mines in Pennsylvania. He bought railroads to transport raw materials. He bought Great Lakes shipping to move ore. Every input, every step, every cost center. This delivered real efficiency. Carnegie Steel produced rails 50% cheaper than competitors by 1890. Infrastructure costs dropped. Railroad expansion accelerated. The economy grew. But here's the unintended consequence. Every competitor who didn't integrate vertically became structurally disadvantaged. They paid market rates for inputs Carnegie produced internally. They paid shipping rates on railroads Carnegie partially owned. Competition didn't disappear immediately. It became unsustainable. Rockefeller did the same in oil, but deeper. Standard Oil didn't just refine crude. It built pipelines to bypass railroads. It owned tank cars. It controlled distribution terminals. It even owned the barrels. By 1885, Standard Oil's logistics network was so dominant that independent refiners couldn't get their product to market efficiently, even if they somehow matched refining costs. Rockefeller also pioneered byproduct monetization. While competitors treated refining waste as disposal costs, Standard Oil turned it into products: kerosene, lubricants, paraffin, petroleum jelly. Revenue per barrel doubled. Competitors couldn't match it. The public benefited. Kerosene prices dropped 80% between 1870 and 1890. Lighting became affordable for working families. Living standards improved. Journalists called it the democratization of light. What they didn't emphasize was the consolidation of control. Prices improved. The plumbing tightened. The first cracks appeared not in the markets, but in the courts. In 1890, Congress passed the Sherman Antitrust Act. It prohibited combinations and restraint of trade. But here's what made enforcement difficult. Neither Carnegie nor Rockefeller used force, they used structure. Standard Oil wasn't technically a monopoly under the traditional definition. Independent refiners still existed, but they operated in a system where the infrastructure itself was owned by their competitor. Pay attention to this part. In 1892, Ohio's Attorney General filed suit to dissolve Standard Oil's trust structure. Rockefeller responded by reorganizing as a holding company in New Jersey, where corporate law was more permissive. The legal form changed. The control structure didn't. Carnegie faced different pressure. Labor. In 1892, workers at Carnegie's Homestead Mill struck over wage cuts. Carnegie was in Scotland. His partner, Henry Clay Frick, hired Pinkerton guards. The confrontation turned violent. 10 people died. Public opinion shifted. Carnegie's reputation as a benevolent industrialist cracked, but steel production didn't. The strike was broken. Wages stayed down. Costs stayed competitive, and that was the problem. The system had become so efficient, so structurally dominant, that neither legal challenges nor labor action could alter the core dynamic. Nothing collapsed. And that was the problem. By 1900, Carnegie Steel and Standard Oil weren't just companies. They were infrastructure. Dismantling them meant disrupting the industries they defined. The inflection point came in 1901. Carnegie was 65. He wanted out. But selling Carnegie Steel wasn't simple. It was the foundation of American industrial capacity. Enter J.P. Morgan. Morgan understood that Carnegie Steel's dominance created instability. If Carnegie flooded the market with cheap steel to crush competitors, it would destabilize the entire sector. If he sold to rivals piecemeal, it would trigger a consolidation war. Morgan's solution? Buy Carnegie outright and fold his assets into a new entity, U.S. Steel. The deal closed in February 1901. U.S. Steel became the world's first billion-dollar corporation. It controlled 66% of American steel production. This wasn't a free market outcome. It was a managed transition. Morgan essentially nationalized the steel industry privately. Rockefeller's breaking point was slower but structural. By 1904, journalist Ida Tarbell published The History of the Standard Oil Company, a meticulously documented investigation into Rockefeller's practices. It wasn't sensational, it was methodical. She revealed the railroad rebates, the pipeline monopolies, the quiet acquisitions, public pressure mounted. President Theodore Roosevelt filed suit in 1906 under the Sherman Act. In 1911, the Supreme Court ordered Standard Oil's breakup into 34 independent companies. But here's what's critical. Rockefeller owned shares in all 34. When they became independent, their stock prices surged. His net worth doubled. The structure was dismantled. The wealth remained. From this point on, the outcome was no longer optional. The breakup of Standard Oil and the formation of U.S. Steel didn't eliminate concentration. They formalized it. U.S. Steel remained the dominant producer for decades. The 34 Standard Oil fragments eventually reconsolidated into ExxonMobil, Chevron, and other modern giants. But something else shifted. The relationship between capital and the state. Before 1901, industrialists operated with minimal federal oversight. After U.S. Steel and Standard Oil, the federal government established itself as the arbiter of acceptable market structure. The Interstate Commerce Commission gained enforcement power. Antitrust law became a permanent feature of American capitalism. The Progressive era regulatory framework was built on the precedent these cases established. Who benefited? The public got cheaper products and infrastructure expansion. Workers faced wage suppression and violent strike-breaking. Shareholders, especially those positioned early, accumulated generational wealth. Carnegie spent his final years funding libraries, universities, and concert halls. His philanthropy reshaped American civil society, but it was funded by market dominance that crushed competitors and suppressed labor. Rockefeller did the same. His foundation eventually eradicated hookworm in the South, funded medical research, and built the University of Chicago. The wealth that came from structural monopoly became the foundation of American institutional philanthropy. Power didn't disappear. It was laundered into legitimacy. If you value analysis that treats financial history seriously, subscribing the channel simply ensures you don't miss work like this. The Carnegie-Rockefeller era wasn't about personality. It was about incentives, infrastructure, and the compounding effects of structural advantage. Today, we see parallel patterns: cloud infrastructure, payment networks, search and advertising, social platforms. These aren't products, they're plumbing. When a company controls the infrastructure layer, competition shifts from better products to better access. Startups don't just need better technology, they need distribution, data, and network effects. Just like Carnegie's competitors needed ore, coal, and railroads they didn't own. Here's the rolling top logic. Late cycle dominance looks like strength. Market caps grow, efficiency improves, prices drop. Regulators hesitate because disruption feels risky, but underneath, flexibility disappears. When Carnegie sold to Morgan, he timed the top of his structural dominance. When Standard Oil was broken up, Rockefeller's wealth surged because fragmentation unlocked value that consolidation had compressed. Prices are the headline. Plumbing is the story. The modern equivalent isn't oil pipelines, it's data infrastructure, cloud dependencies, payment rails. If you control the layer beneath the product, you control the incentive structure. History doesn't repeat events, it repeats incentives. Late cycle psychology today mirrors the 1890s. Dominance feels permanent. Efficiency justifies consolidation. Disruption seems unlikely because the system works, until it doesn't. But the shift doesn't come from crashes. It comes from regulatory reclassification, technological disruption, or generational transitions in capital allocation. Carnegie and Rockefeller didn't lose. They exited at the top. Their structures were dismantled after they were gone. The question today isn't whether concentration will end. It's whether you'll recognize the transition before it's formalized. Positioning over forecasting. Awareness over prediction. 2 takeaways. First, about systems. Monopolies aren't built by villains. They're built by optimizers who solve real problems. The danger isn't malice, it's momentum. Once a structural advantage compounds, the system resists change even when change is necessary. Carnegie and Rockefeller created efficiency. They also created brittleness. The market couldn't self-correct because the market was their design. Second, about behavior. Wealth consolidation doesn't end with regulation. It transforms. Breakups redistributed control, but not wealth. Antitrust law didn't prevent future concentration. It just changed the rules. The families and institutions built on industrial monopoly still shape capital allocation today. Rockefeller's descendants still influence energy and philanthropy. Carnegie's legacy funds, research and culture. Power adapts. If this helped you see the system more clearly, consider liking the video and subscribing. Not for predictions, but for perspective. The patterns are old, the plumbing is new, but the structure underneath hasn't changed as much as we think.